Hey, welcome back, Accounting 604. We are now in our fourth video in Module 6 dealing with long-lived assets, and we are continuing to look at our treatment and analysis of property, plant, and equipment, or PP&E. And as you can see in this first title slide, in this video we're dealing with PP&E capitalization and depreciation. So when we talk about the topic of capitalization and then resultant depreciation, let's see if we can set the stage with this next slide. PP&E assets, of course, are for firms that own property and equipment. It's typically the largest asset you're going to be dealing with. And typically it is recorded on the balance sheet at cost for acquisition as well as transportation to site, installation, and testing. All of those costs involved in putting the asset into service are then capitalized or placed on the balance sheet rather than expensed out as expenses on the income statement. And we've talked about the reasons why in a previous deck, right? It's because they are long-lived assets that will be used to directly or indirectly produce revenue for a long period of time. And so this is why this process of capitalization, or recognizing it as an asset that is slowly dispensed of as its useful life is used up, is known as CapEx, or capital expenditures. And of course, because of the size of typical capital expenditures, this is an area that we watch very, very closely to see how are these assets efficiently used, what productivity comes out of them, what is the return that management is able to yield from them. But as you can see, just the concept of not expensing it directly in the income statement, but rather placing it first, valued at cost as an asset on the balance sheet, is this process called capitalization. On this next slide, you see then once that PP&E is capitalized, then the cost is slowly recognized as an expense over time, over the time period that PP&E is still useful to the organization producing revenues, either directly or indirectly. And so when we talk about slowly being used up, its useful life deteriorating, or however you want to put it, this is technically what we call depreciation. Depreciation, of course, a concept that should be familiar to most of us now, perhaps not from the world of property, plant, and equipment, but certainly from the point of view of a personal automobile, an auto vehicle, right? Why is it that a used car costs more than the exact same car if it was brand new? And the reason is technically the concept of depreciation, which we are so used to in that realm and in similar kinds of things in our personal life, right? Depreciation conceptually recognizes the truth that a long-lived asset is gradually used up. Its useful life is used up over, in this case, probably several years, right? And so many companies realize this is a very, very large expenditure. Aren't there a manifold list of possible advantages to leasing the equipment rather than purchasing it outright and owning it? And indeed there are, for a number of different reasons. However, from an accounting perspective, you can see in the last two bullets on the slide, when a company chooses to enter into long-term equipment leases, that long-term defined as extending beyond a year, then that equipment is capitalized just like other tangible assets in conceptually the same way as if a company actually owned them, right? Because those kinds of assets are typically treated for accounting purposes in very similar ways, right, as if they were actually outright owned. And so we still approach them as capitalized assets subject to depreciation over its useful life. Now, in order to depreciate these long-lived assets, the asset has to make three estimates and has to be able to make these three estimates. You see them there. First of all, you need to determine what you believe to be the useful life, the period of time over which the asset will be generating measurable benefits. Now, this is useful life, not durable or practical or real life. In other words, if you were to say, hey, I just bought this white van, and this van is expected to be, let's say, a 5-year useful life to the organization, it doesn't mean that in the first day of the 6th year that the car just completely disintegrates or falls apart into a pile of rust. Of course, we understand that. What we're talking about is, generally speaking, a useful life that generates measurable benefits. And in this case, in the terms of an automobile or a white panel van, there comes a time in the life of a motor vehicle where the cost of maintaining and repairing it simply outstrips it from useful service, right? It just becomes too expensive to continue to own. So first of all, you need to estimate in years what is the useful life. Then you are estimating at the end of this useful life to the organization, what do you believe to be the salvage value at the end of that period? In other words, you see they're defined salvage value, the amount expected for the asset when disposed of at the end of its useful life. And you may find, for instance, with this earlier example of the white panel van, that the end of the 5-year useful life, it's worth, what, $2,000 or something like that. You're going to sell it on Craigslist or eBay or wherever, right? Okay, but you determine a useful life and a salvage value. You already know the purchase cost, therefore the original value. You basically have beginning, end, and the period of time between them. And then, given those 3 items, your original cost, your salvage value, and the useful life, you choose as an organization what is a reasonable depreciation method that you will use for the entire useful life of that asset, generally, how you are going to calculate the rate and the amount of the value of the asset being used up. Now, we give you an example. The most popular method of depreciation used by organizations is overwhelmingly been the straight line method. And so let us just illustrate that for you. Assume a company acquires a machine, a piece of equipment, as follows. You see there, the original cost is $100,000, and the salvage value is, at the end of the useful life, will be $10,000, which means that the amount to be depreciated, or the depreciation base, is of course cost minus salvage, or $90,000. That $90,000 will be depreciated in a straight line linear fashion for the amount of the time, the number of years that you are depreciating this asset. You can see there in the second box, they believe the useful life to be 5 years, which essentially means that every year 20% of the depreciable base will be used up. And so in this case, with straight line, $18,000 in depreciation expense is recognized per year over the asset's estimated useful life. Every single year, the exact same amount, a straight line, $18,000 a year. You take the depreciation base, divide it by the number of years, you end up with $18,000 per year. And so, obviously, what you see here is very simple to calculate, pretty simple algebra. It's just a straight line, right? This depreciation calculation will also recognize what we describe as net book value. And you can see here what that means. Every year that you are depreciating $18,000 to the accumulated depreciation account, every year $18,000 of depreciation expense goes into this accumulated account, which, as you might guess, first year is $18,000. Second year, you add another 18 for a total accumulated depreciation of what? $36,000, etc., etc. And so you see what the reporting of this ends up to be, right? The contra asset account of accumulated depreciation grows over the years, reducing net PP&E. And so at the end of the first year, you see here the machine reported at cost less your accumulated depreciation, which of course in year 1 is $18,000. Therefore, your net book value is essentially just the difference, or the original cost minus all of your accumulated depreciation. And as you might guess, over the course of the 5 years with this particular machine at least, what will end up happening is that the accumulated depreciation account will continue to grow, and the net book value will continue to fall until at the end of its useful life, of course, it reaches $10,000. Now, there are other depreciation methods that are used from time to time. Again, we underscore the fact that straight line depreciation, that method is by far the most popular and always has been historically. But there are accelerated methods that are sometimes used that the IRS and GAAP allows to record more depreciation in an accelerated fashion in the early years of an asset's useful life. And then it essentially slows down and less depreciation in the later years. And of course, what that does is it increases your non-cash expenses, and that may be useful to you for taxation purposes, for instance. However, there is another method. You can see here your second bullet point, the units of production method, which essentially assigns the rate of depreciation commensurate with the actual production use of the asset. And so, as always, depreciation base is cost less salvage value. That doesn't change, right? But the depreciation rate is calculated as units produced compared with the total expected units to be produced and sold. And so, for instance, with the case of this machine, let us say it is a production machine that we were talking about, and it was anticipated in its useful life to be able to produce, say, 200,000 units, then you would use that as the method of calculating your long division for how much of the useful life is used, calculated as commensurate versus this fractional amount of 200,000 units actually produced, you anticipate, over the lifetime. Finally, there is another accelerated method, MACRS, or the Modified Accelerated Cost Recovery System. This is also another accelerated method required by the Internal Revenue Service to calculate taxable income. So just realize that as you are looking at depreciation expense of long-lived assets, typically PP&E, that it is a math calculation based upon these estimates, the original cost, which is not an estimate, of course, but an estimated useful life, and then estimated salvage value. Some method, many times straight line, will be applied to do the math in order to describe what is really the useful life used and remaining of CapEx. And of course, as we've mentioned before, this is a very useful insight into future CapEx expenditures that you would expect in order for management to continue to keep production facilities useful and in good repair for the sake of producing revenue. Last couple slides in this deck deal with a special type of facilities and equipment. You see it here, research and development. And the reason we mention this is because we've just belabored the point that long-lived assets are, in the case of PP&E, depreciated over time. We want to remind you, as we've mentioned in a previous deck, research and development facilities and equipment are not capitalized. They are typically expensed on the income statement as used. So the only exception to this is if R&D facilities and equipment are general use in nature, and therefore you can approach it, even though perhaps they might be used for a time for research and development, if really they are general use assets that will reasonably be used for other activities besides simply R&D, those are capitalized and depreciated, as we've just talked about in the previous 7 slides. But typically, specific R&D facilities that have no alternative use are expensed immediately. And there are some reasons why. You can see 3 of the reasons here. Yes, we anticipate R&D costs, at least in the aggregate, to eventually create future benefits, and therefore we might look at them as assets that the company manages and owns in order to produce future revenue. But the reason they're not capitalized is because we are simply uncertain which of any of the R&D efforts and programs and projects will specifically produce any benefits whatsoever. And of course, a great number of our R&D programs will run their entire course producing, well, absolutely nothing measurable. And even if they were measurable eventually, we have no idea in terms of time frame. And therefore, we simply approach it with the concept of accounting conservatism to simply expense them, since the outcomes, the positive outcomes, are uncertain and unknown at any particular point in time. They cannot be reasonably measured, and therefore we approach them as simple expenses rather than capitalized assets. Some insights from this then. Capitalization. It shapes both assets and earnings, and so you can boost your near-term earnings and assets on the balance sheet, and that will affect profitability and leverage ratios depending how you approach capitalization and, of course, depreciation methods, which are strategic levers. You can, as a managerial decision, choose a depreciation method that is a useful tool to manage your earnings. So you have to consider what management has chosen in your analysis. And finally, the way that GAAP looks at treating R&D, which essentially highlights risk versus future potential, the risk that in any particular R&D project may yield absolutely nothing, means that if you're really going to evaluate long-term growth, you have to look beyond the mere GAAP principle of expensing R&D expenses and really do a little digging. Exactly what are these R&D projects, as best as you can find in disclosures, and really what is the likelihood that they really might yield something? That is something that an expert can ask better questions about, and yet even then there will be sometimes a very high level of uncertainty and risk involved. So that gives us just another brief look at some of the other aspects of how we deal with long-lived assets and some other perspectives in your analysis and some questions to continue to pursue. I hope that's helpful, and we'll see you in the next video.